What if I tell you that the candlesticks you memorize all day do not actually move price? Have you ever sat down on a candlestick chart and wonder, what is actually the reason why these candles are created? Why are they created and what is even creating them? You see, majority of us traders, we focus on memorizing the chart, the candlesticks, finding out or wanting to know the doji, the bullish engulfing and all of that. But very few of us traders actually come down to understand the reason why those candlesticks are created in the first place. So once you start understanding why the candlesticks are created, that is when the market will start making more sense to you as a trader. So a candlestick is not a magic. It is not an indicator. It's not even a signal. A candlestick is a representation or an image or even a picture of the activities that happen in the market at a particular period of time. For example, if you are on a 1 hour chart, each 1 hour candle represents the activity of the market within 1 hour. Now, if you are on a 4 hour chart, each 4 hour candle represents the activities of the market in the 4 hour interval. If you are on a daily, each daily candle represents the activities of the market within a day. So you can see that the market is not actually, or the candle is not an indicator. It doesn't even signal you anything. It just tells you the activities of the market within that particular period of time. So every candlestick is created from 4 pieces of information. That is the open price, the high price, the low price, and then the close price. So let's quickly go over to the chart and look at one example. So now we are in the chart right here. So if you look at this candle here that I've just marked out, you can immediately see the high of the market where we had the high right here, the high. Now we had the open price. Okay, this is the high price, the open price right here. We had the open price here. Now we had the low right here, the low right here, and now we had the close price right here. So you knowing the different price points of the candle creation is not enough. So we're actually going to go back into the chart to explain the reason why that candle was created. What was behind the scene of the creation of that candle. So let's get back again into the chart. All right, so we are in the chart again. So the first thing I want you guys to notice is that we are in a daily time frame and we are on the GBP USD chart. So the next thing I want you people to notice is the trend of the market currently in this particular period of time that we are trying to get this example, this point here. So you can see that the market is trending downward. So the first question is, why do we even need to, or why does the market need to create another bearish candle at this place? The very simple answer to that is because we are already in a downtrend. So the market is creating this bearish movement here because we are already in the downtrend. The market is going down already. So how is it created? How is this candle created? Now, first of all, or what is even making it, what is creating it? The first thing you want to notice is this price here, 1, 2, 3, the 3 candles before this one. You can see the price was trying to come down, right? And we have this little bit of bullish candle. If I'm to zoom out on this, if I'm to go down to a lower time frame, you will see that this was a kind of something like this. Then we kind of sweep this liquidity here before we dump, right? So this was a kind of like a liquidity pool. This was a liquidity pool. They were trying to gather enough order at this particular point. So why is this created, all right? Or how is this created? You see, the market came and swept this liquidity first of all. That is the first thing you want to notice. This was a liquidity pool. In a bearish candle, we had this bullish. Remember, if I go down, you see the liquidity pool. So we swept this liquidity here and we created the high of the market. Now, why did this go out to sweep this liquidity? Because without sweeping this liquidity here, we will not have this bearish movement. Now, remember, this is where the market opened, right? So it went up, swept this liquidity. Now, this sweep becomes the high price. That is the highest point price has gone before it started coming down that we are seeing. Now we've come down to the low of the market. This is the lowest price. Now the market close out here. So what is even the psychology of this thing? So the market open here. The buyers, the buyers that were supposed, remember this candle closed as a bullish candle. So we presume that the buyers were actually, or the sellers were actually trying to accumulate the market to sell more, right? So the sellers opened the market right here. So they manipulated this market up to this point. So this was actually a manipulation. This was a manipulation. So the market dropped. They actually, after the institution might have manipulated this, they dropped the market lower, taking down all of this other liquidity that we have, and then took the price down here and closed. So this was actually from here, from this point here, this particular wick that we have here was manipulation from buyers. Now, because I'm also a trader, so I would prefer calling it manipulation, but this is not actually manipulation. It's just an institution looking for where there is more liquidity to execute their orders. So at this point, there was more liquidity at this high, at this place. Now, remember I said this was a liquidity pool. Now, this liquidity pool right here, there was enough liquidity, so the market swept all through all of that. We traders call it manipulation, but if you ask the institutional traders, they will tell you they were just trying to look for a better place to fill in their orders. So after that, they pushed the price down and lower, taking down all of these other points that we had here. Of course, you see, after this swept, we had all of this movement coming down to that place. So it is very, very important for you to note that and keep that in mind. So you might want to ask, if the candlestick does not move the market, then what moves the market? Well, the candlestick actually does not move the market. What moves the market are the people involving in the market. You see, in an institutional level, we have institutional buying, we have them selling, we have even retail traders buying and selling, some taking profit, some entering the market. Now, all of those movements and all of those things happening in the market, the footprint, or for you to know that all of those transactions happen in the market, a candlestick is left behind. So the footprint of transaction, buying, selling, traders entering and going out of the market is the candlestick is a representation of that particular transaction going in and out of the market. So candlestick itself doesn't move the market, but candlestick is a representation of the transaction, the pictorial representation of the transaction that happened in the market subsequently. So four prices actually created the candle that you're reading all day: the high price, the open price, the low price, and then the closing price. So beyond all of these prices is something more deeper, which is the buyers and sellers reacting in real time. So you can look at the candle, all these prices created, but you need to actually understand, why is that candle created? What were the buyers doing? What were the sellers doing? Were the buyers reacting, or were they trying to just dominate their trend? Or was it the sellers reacting and the buyers were trying to dominate their trend? So whichever way, you want to understand the reason why that candle is created. I mean, you want to look at the trend of the candle first of all. Okay, the candle is created in its own trend. So why is it even created in the first place? Institutions have taken liquidity here, so they push price again in their further direction. So it is important for you to know all of these things and the factors, enhancing the creation of the candle. So once you start seeing the market in this way, the market stops feeling random to you. It's just another storyline you need to see. So it is important, and it is something every trader needs to learn how to read properly. So guys, we've come to the end of this video. If you enjoyed videos like this, you might want to subscribe to the channel, you turn on your notification bell so that you get content like this when it is published. I mean, in the channel, I actually have why price moves. I mean, the reason behind price movement. So you want to go and check that out, or even I'll be leaving the video up here so that it will aid you in navigating the channel. So with that being said, I'll see you guys in this other video. Bye for now.